What role do interest rates and maturities play in bonds?
We fight for your money.
It's a very central and absolutely crucial factor what precise kind of financial deal I'm actually entering into as a potential investor. The fundamental point here is, in my own mind, I am essentially the bank, providing the necessary capital. I benefit when I receive interest payments over a longer period of time. That's what I want to do when interest rates are high. But if interest rates are low, then I definitely want to go for short-term maturities because I'm not getting high interest. If the interest rate level changes during the term, then this also has an impact on the price of the bond. Bonds are traded on the market, and this means that bonds react to changes in the interest rate level. Let me provide a clear example. If you had indeed purchased a long-term 30-year US government bond in August of 2020 and subsequently sold it today, you would have unfortunately experienced a substantial loss of 40% of your initial investment. The bond dropped from 100 to 60. Is that because people believe the US government is going bankrupt? No, definitely not. The reason is that at the time in 2020, the bond had an interest rate of 1.2%. Today, it's almost 5%. That means that today, when the US government issues new debt securities, it has to pay 5% interest. But that means that the bond that has already been issued also has to rise to the same interest rate level. However, the coupon is fixed, and this adjustment happens through the market via the price of the bond. So for someone who bought long-term US bonds in 2020, and it's the same in Germany, they would have lost about 40% of their money if they sold today. Interestingly, banks that also held bonds do not have to write this down in their balance sheets. It's a completely absurd situation because they can simply record it in their balance sheets at the same price they bought it for. The principle of commercial prudence does not apply here. This way, the state is able to offload more bonds. But the point is, as a private investor, as an investor, I really have to think carefully about how maturities are changing, how interest rates are changing, and which maturity I should choose accordingly.
So, do you generally recommend investing in long-term, short-term, or perhaps medium-term bonds? Because I think there's a large market for short-term bonds, that people like to buy short-term bonds while they're not as motivated to buy long-term bonds.
Yes, the right answer here is it depends. The point is, you have to assess that short-term bonds be short-term, bonds with maturities of 3 to 5 years, so short to medium term have the advantage that the interest rate risk is practically eliminated. Because if I hold on until maturity, I get my money back. The fact that the interest rate level has changed in the meantime doesn't matter. Because if I bought the bond at the issue price of 100 and I get it back at 100 at maturity, and I've received my interest payments, then it really doesn't matter whether the interest rate level has changed. But in certain situations, it can also be quite attractive to lock in the interest rate level for a longer period of time. Let me give you an example. At the end of the financial crisis, the market was very nervous, and as a result, companies had to offer very high interest rates to the market in order to issue bonds. And back then, there were 2 bonds that we also bought for clients. One of them was a bond from Daimler. It had a coupon of 9% and a maturity of 2 years. We thought, wow, this is really a good deal. It was still secured for 10 years, and we also bought the bond back then. For 2 years, you received 9% and 9%. At the same time, there was a second bond that we also bought. That was from John Deere, the big tractor manufacturer. And it had a bond with a 10-year maturity and an 8.5% coupon. A little less. So we thought, okay, both deals were fairly good. But the point was they paid 8.5% for 2 years. After 2 years, both companies were able to refinance at 1 to 2% again. The worries from the financial crisis had faded and the market was open again. The Daimler bond had matured and Daimler issued new bonds, then with a 1 to 2% coupon. John Deere did the same. They issued bonds with a 1 to 2% coupon, But this bond was still on the market and it couldn't be redeemed early, and its price was at 160. And accordingly, that was a very important learning experience for us. In the end, we made a major mistake, and we gave in to the temptation to buy Daimler at 9% for 2 years. The right move would have been to focus much more on the John Deere bonds that were available at the time and to lock in the interest rates for a longer period. Because someone who invested in the Daimler bond received 18%. Someone who invested in the John Deere bond received 17% plus a 60% price gain. Accordingly, when interest rates are high, you have to lock in those rates for a longer period. It's a very important point to keep this mechanism in mind.
Very nice. So if you're interested in bonds and want to know more about them, and if you're considering adding bonds to your portfolio, feel free to give us a call. I would be happy to arrange a meeting with Helga Muller for you, take a look at your portfolio, and study how we can incorporate bonds here. This can be especially interesting for older generations, for people who live abroad and receive pensions, in other words, for those who rely on regular payouts. With bonds, it's not like with stock. With bonds, you already know in advance what you're going to get. The only thing is you have to choose the right issuer. And that's where Helge is, of course, the top guy, because he actually goes into the companies. He visits the issuers face to face, goes into the company, looks at the balance sheets, talks to the key people, and selects issuers where no mistakes are made. That's why I have also invested part of my private assets with Genève Invest. That's the name of Helge Muller's company. And I have to say, I am very satisfied with it. Thank you very much. Goodbye, and see you on our YouTube channel.